All right, thank you again for attending the workshop tonight. My name is Sean McDermott. I'm the president and owner of Summit Investment Advisors. I'm also a certified financial planner. I have here with me this evening Nathan Crampy, and Nathan is also a certified financial planner. He's going to be doing a section of tonight's presentation. And I also have Dan Freemuth. Dan is a certified public accountant. And Dan's firm actually started in 1979, 35 years ago, and Dan's been working there since he is a young lad and working with his father and so forth over the years. So Dan is here. He's going to do a section on the tax planning and then answer any complicated questions that you might have for us this evening. As we go through the material, feel free to ask questions as we go along. The slides that I will cover are in your handouts, and so they kind of follow right along, so take good notes. And with that said, thanks again for coming. I actually started working with Medtronic employees over 25 years ago. The first employee I worked with, Sharon, she said to me, you know, Sean, the benefits that we have at Medtronic are fairly complicated. We have stock, we have ESOP, we have pension, we have 401k. Could you come on in and help us understand all these different benefit plans? I said, you know, I'd love to do that. And we set up a workshop and sent out some invites. And it was 4 o'clock on a Thursday. And I didn't even go because we didn't have anybody that registered. I got a phone call about 4:15. It was Sharon on the phone. She said, Sean, aren't you coming on over here? Me and my friends are here. and the first workshop that we did was at, I think it's called Biff's right now. I think it was Bleachers, the place at the volleyball courts, the bar and grill. And then we graduated from there to the Sunshine Factory. Anybody remember coming to there? And then we went to the Shorewood. You remember the Shorewood? I think it burned down now. But so we've been different places over the years, and now we've moved into our own conference facility, and we've grown from having no registrations to over 80 registrations today. So again, thank you for coming, and thank you for passing a good word. Sharon, she told me, she said, these kind of words burned in my mind years ago. She said, you know, what I appreciate about your firm is you can explain things in a simple manner that I can understand, and that's what we hope to do tonight is make things so you can understand what's going on with all these different tax laws and implications with the tax inversion. The other thing that she said is that she can trust that we know what we're doing and that we're going to do the right thing for our clients. And hopefully, you know, we've shown you that over the years. So with that said, a couple things. Nate, I got, I'm not seeing a screen here. Yeah, little fade out here. Yeah. So just a couple things that we're primarily talking about tonight. There's a few people in the group that might not work at Medtronic, but we're going to talk a lot about Medtronic stock because on June 15th of 2014, Medtronic announced their acquisition of Covidien. And so with the acquisition comes a thing called a tax inversion where they're moving their corporate headquarters to Ireland. And with a tax inversion, what happens for those people that have stock in Medtronic Corporation and a stock isn't held inside of a retirement plan, those people have to realize the gains on their stock when the inversion happens. So basically it's a taxable gain to the shareholders of Medtronic. And so what we're going to focus in on tonight is, well, what can you do to lessen the tax and lessen and prepare for this acquisition so you don't get caught up in a lot more federal and state income tax than you really need to pay. A couple things that we do know about this tax inversion is they can do it. It's under current tax law. And so it's perfectly the corporation's right to do it, and it's a smart thing to do for corporations. We don't know when it will take place. It could happen in 2014. It could happen in 2015. So that's unknown at that point. Our speculation is that they probably want to try to get it done as soon as possible, sooner than the government can say, okay, well, we don't want you to do this, and they try to block it. And so you probably saw that recent article that I emailed out, and you might have seen it in the newspaper. The U.S. Department of Treasury is trying to clamp down and stop tax inversions because they lose out on a lot of tax revenue when U.S. corporations move abroad, okay? For the corporation, it's a great deal because they're saving 20% in federal taxes. You know, it's a big tax break. For shareholders in a corporation, well, it's probably a good deal for you because there's a lot less tax to pay as the corporation grows, you know, worldwide. So we do know that it's likely to move forward. It's not 100% at this point in time. We do know that when the inversion happens, you have to realize taxes on whatever stock gains that you have. And so our main goal tonight is to prepare you for that. And by being prepared and by being proactive, what we've found so far with different tax calculations that we've run for various clients is that your savings could be anything from $1,000 to over $100,000 of taxes. We had a couple people in the room earlier today that their tax savings will be over $100,000 by making certain moves, okay? So might want to pay attention to the rest of the workshop. So kind of the main agenda, we're going to talk about calculating stock cost basis. That's step one, is saying, okay, well, where are we at if this inversion goes through? What is our capital gain? We're going to talk about how taxes work because you kind of have to have some fundamental knowledge as to where you sit with your own tax bracket because your own tax bracket is going to determine what the capital gain tax rate is going to be when this happens. We're going to talk about the stock strategies, and Nate will talk through 6 different strategies on how to save on taxes. And then we'll go through some next steps. We'll have Q&A as we go through the material and then also at the end. Now the first step is we need to look at our employee stock that we own, and we have to figure out how do you calculate the taxes on it. So the employee stock purchase plan features, I'm going to walk through this. We'll look at the tax qualified ESPPs tonight. We'll go through some tax examples. We're going to look at the direct purchase plan shares and then also the dividend reinvestment plan shares because those are different things. So the direct purchase plan shares might be if you bought shares of Medtronic on your own. You went to a brokerage account like LPL or Fidelity or Vanguard and you said, I'm going to buy 1,000 shares of Medtronic stock. Or the dividend reinvestment plan might be where you've already owned the shares at Wells Fargo or a brokerage and they're paying the dividends, but you keep buying more shares as the dividends are paid out. So that's the dividend reinvest direct registration. So there's a couple different ways that we're going to be looking at these examples. Now there's employee stock purchase plans, there's qualified ESPPs under Section 423. 95% of corporate shareholders that have plans offered like this are under Section 423 of the IRS code, and that's what Medtronic employees have. There's another type of employee stock purchase plan, that's a non-qualified stock purchase plan, and not a lot of people have these. These work more like stock option plans. Non-qualified stock options, they work more like RSUs and things like that. We're not going to talk about those tonight. We're going to have a workshop on that in October. So if you look at some of our workshops coming up this October, we're going to talk a lot about stock options. Open market or direct purchase plan, that's where you're just buying the stock directly. So some of the employee stock purchase plan features, and this again is on the Section 423 plans, the ones that you own. Employees can enroll in the plan. Typically you have to work at a company full-time and then you can enroll in the plan. You generally can deduct 2 to 10% of your salary can go into the plan to buy shares over time. They're not pre-tax like a 401k. So you don't want to get these confused with your 401k plan. That's completely separate. So the stock purchase is a different election and it's not pre-tax. There are some tax breaks on it, however, and I'll talk about those in a second. But offering period, basically these days, on a quarterly basis, you're buying stock in the plan as it's deducted from your salary. Some of the key rules, and I'm not going to cover all these because we're going to try to move through some of these slides and get more into the tax examples, but you can contribute up to $25,000 to these plans per stock year. or up to 10% of your salary. And this is another feature that a lot of people are aware of, but there's no tax at purchase on the shares. There's never any FICA withholding. So basically, when you're buying shares of stock, you don't have to pay Social Security tax, and you don't have to pay Medicare tax. Could you give me a water, please? Start talking about taxes, it just chokes me up.
We know the feeling.
Yeah. So you have a 7.65% savings on whatever you're putting into the employee stock purchase plan shares. And then the other benefit, excuse me just one second. Just talk amongst yourselves. Thank you. Oh, much better. So the other benefit of when you're purchasing these shares is there's an employer discount portion. And at Medtronic, the employer discount is 15% of the market value on the purchase date. So not only do you get a 15% discount, but then you also save the 7.65% in the FICA tax. So it's like a 23% rate of return when you're putting money into the plan. So it's a good idea to participate in this type of plan. Now there's when you sell the stock, there's different ways that it's treated tax-wise. A qualifying disposition is if you hold the stock for 2 years, then it's a qualifying disposition and it qualifies for capital gain tax treatment. If it's held for under the 2 years, then it's going to be taxed as short-term capital gains or ordinary income, which there are different tax rates, which we're going to talk about a little bit later on tonight. Okay? So you have to hold the stock more than 2 years for it to qualify for long-term capital gain tax rates. This is an interesting bullet point. W-2 reports ordinary income on Form 3922 for the prior year's purchases. Anybody ever seen 3922 form? Raise your hands if you've seen this form before. Anybody in here own Medtronic stock? Yeah, a lot of people. This form they didn't start sending out until 2011, and a lot of people don't pay attention to it because you don't have to file it with your returns. But what it does is it reports to you the employer discount on your stock. So remember, the employer discount is going to be taxed differently than a long-term capital gain. So this form is telling the IRS that you guys got a discount on your stock, and so when you sell that stock down the road, if you don't put on your tax return that you got a discount on it, then it's a red flag for an audit. So there's a lot of tax people that don't do this on their older shares. After 2011, the IRS or the stock agent and employer is required to send this out to you. So that's why you're probably not familiar with it, but it's there, and you need to know about it.
So they've never sent these out before 2011?
They've never sent them out before 2011.
So the IRS doesn't know about them?
The IRS might not know about it, but if you get audited, the IRS could say, well, what is the basis? And it's not too hard to figure that out.
They ask you when you do the taxes. Yeah, you're supposed to be doing that based
Yeah.
on your cost.
And the new tax forms, which Dan is going to go through some examples, and actually inside your folder I put in a handout that talks about Form 3922. So if anybody in here is doing their taxes on their own, then there's an example in there, and it's a little bit complex with all the reporting that you have to do these days. Yes? Yeah, the Form 3922 is automatically mailed out to you every year. Yeah, you don't file it, but it's for informational purposes. Okay. There's another form that I put in your handout there. Is it 8988? Yeah. So if you, I put a form in there that says, I think it's Form 8988. So if you own over $50,000 of a foreign corporation stock, what is it? 8938. So you're going to have to file 8938 also. So once this acquisition goes through, then once a year, if you're doing your own taxes, by the way, it's a foreign corporation, so you got to file this along with your taxes.
There's no tax consequence.
Is there a tax consequence, is the question? Dan?
There should be no tax, it's just reporting only. It's just telling them that, hey, even now, if you have investments of over $10,000 out of the country, you already have to report it to the government. And this is just expanding it a little bit more broadly.
Okay. So let's talk about how taxes work. So we're going to go through the fundamentals, and then we're going to talk about how your fundamentals impact the taxability of your stock. So we'll look at determining tax liabilities, marginal tax brackets, personal exemptions, itemized deductions, how it impacts capital gains and dividends. We'll look at the AMT tax, net investment income tax, taxes on Social Security benefits, state taxes, and tax case studies. Pretty exciting, huh? We all have nothing left. I mean, it's all taxed. So basic formula for determining your income tax is they take your gross income. Your gross income is your wages, could be your pension, Social Security, dividend income, capital gain income. Everything on the first page of your tax return, in the upper half of your tax return, ends up to be in the area of gross income. And then from there, you'd subtract adjustments, and that's typically on the bottom part of your tax returns. We have some example tax returns that we've included in your kits there. Don't pull them out right now, but at the bottom line of your return, after you do some adjustments, it could be an IRA contribution, you come up with your adjusted gross income. Then you go to the second page of your tax return, and you subtract out your deductions and your exemptions. The deductions could be a standard deduction where you don't have enough itemized deductions. So itemized deductions would be if you're adding up your property taxes, your interest on your mortgage, charitable contributions, could be some medical expenses. So you add those up, and if they're greater than your standard deduction, then you're going to be able to itemize. All right? The other itemized deduction that we're going to talk about tonight is state income taxes are itemizable on your federal return. And for those people that are kind of going, okay, well, maybe we should sell some of the stock this year. Well, it could be an itemizable deduction for your tax return this year if you're paying it before December 31st. And Dan is going to address that, because that could save you a couple $1,000s of taxes by, you know, that one tidbit of knowledge. Your exemptions would be for every person in your household. So if you're married filing jointly, you'd have 2 exemptions. If you have maybe a dependent at home, that might add another exemption. So you subtract those off, and what you come up with is your taxable income. Once you know your taxable income, there might be, you know your tax liability. There could be some tax credits if you're invested in certain types of investments, or maybe there's some children tax credits, kids going to college, could be a tax credit. Subtract out the taxes you've already paid this year, and then that's where you come up with the line item taxes due. Okay? Now, when you know your taxable income, this is key. So this is something you'll need to know in order to know what your tax liability is going to be. You have to figure out where you fall on this tax bracket scale. So if you're single, if your income is below $9,075, our taxable income is below $9,075, that means you're in a 10% federal tax bracket. So once you're above that, you're in a 15% bracket with the income above the $9,075. So the first $9,000 is taxed at 10%, then incrementally the next portion of your income is taxed at 15%, and it keeps going up from there, all the way up to 39.6% if your income is over $406,000. For married filing jointly, you can see it gradually goes up. Once your income is over $457,000, you're in a 39.6% bracket, and that's your federal tax bracket. That doesn't include your state of Minnesota tax. I think the state of Minnesota tax is up to close to 10. Once you're in those higher brackets.
So this is just federal?
The question is this federal? This is only the federal tax rates. I'm not even getting into state of Minnesota tax rates.
And your
Pat.
stock could bump you into the next,
Yes.
or one up pretty easily.
Yeah, so the question is, can your stock bump you into a higher bracket? So if you had a $100,000 of capital gain this tax year, you know, you might go from the 15 to the 25% bracket, or maybe up to the 28% bracket. So once you know your bracket, or if you had $1 million of stock sales, you know you're way up here. Plus, there's some other taxes we're going to talk about on top of that. Okay, question back there? Okay.
So if you were married and you had 405,000, you got, as a couple, and then you got divorced, you split that in half. At least one would go down to 28%.
Yeah, you can see there's a marriage tax penalty here, can't you? Yeah. What's a marriage worth, huh?
Make sure you let Medtronic know.
Yeah. We usually get the question, should we delay our marriage, Joe? Yeah.
What I was trying to point out, it's
I-
kind of a penalty.
I think they say marriage is grand, divorce is 100 grand, so put it that way. Okay. Once you know or let me talk a little bit more about these higher tax brackets, and then we'll talk about the capital gains tax rates. So when you get into the higher brackets, you could lose your personal exemptions and also your itemized deductions. If you're single, and if you're over $254,000 of income, then your exemptions will phase out 2% for every $2,500 you're over that threshold. And for married, filing jointly at 376, then your personal exemptions phase out. So basically, they take away your deductions. And in addition to that, the higher your income brackets go for married filing jointly and for single, it's basically at the same rate. But what they do is they subtract 3% of your itemized deductions once you go over these thresholds. So you're going to lose your exemptions and lose your deductions the higher that your income goes. We don't have a slide on this, I don't think, but there's one other area. Whoops, I need to go backward a slide. Okay. So there's one other slide, I didn't put it in tonight, but once you get into up to $250,000 or $200,000 for individual, $250,000 for married filing jointly, there's an additional 3.8%. They call it the net investment income tax, the Obamacare tax. They just started that this year. So it's not only could be potentially 39.6% plus 3.8% plus an additional 10% state tax. So quite a bit of, you know, your income could end up going to the government every year. Okay? So it's pretty nasty. Now, once you know your tax bracket, so we've talked about the marginal tax brackets. You could be 10, you could be 15, you could be a 25% tax rate. If you're in the 10 or the 15% tax bracket, your long-term capital gain tax rate is 0%. Okay? So there's no tax if you're in a lower bracket. Remember that threshold, married filing jointly, if you're under $73,500, then you're at 0% for federal capital gain tax. Okay? So why you want to know this, I had some clients in this week, and they're retired, they're taking some money from pension, Social Security, but they're well below that $73,000 taxable bracket for getting into the next bracket. So we said sell $40,000 or take $40,000 of capital gain this year because there's no tax on it. And so that's a proactive tax move, because when the inversion goes through and they have to realize it all next year, well, they're not going to be in a 0% tax bracket next year on all that stock. And so it's a good idea, to say know these brackets. Once you get into the 25% bracket all the way up to the 39% bracket, the capital gain tax rate is 15%. And then if you're at the 39% tax rate, the capital gain tax rate is 20%. So it just kind of keeps gradually going up the more income that you have in each tax year. Okay, questions? Yes?
Kitty tax, gifted stocks to your child, their income would imply that they're down at that zero capital gains, but still
Yes.
For kitty tax, so where is that part? Is it just when you stop having them listed as a dependent, that they now are free?
Yeah, we're going to talk about the kitty tax and gifting shares of stock to children under 19 or 24 if they're still a student. So Nate is going to specifically address that and how much gain you can realize before it bounces back to mom and dad's tax bracket. So we'll touch upon that a little bit later. Because we have a lot of clients that are going, okay, you know, we're thinking about gifting shares to the kids anyway for their education, or maybe it's to help them with a home down payment or a wedding, whatever it is. And they're definitely in a lower tax bracket than we are. So you can actually start to gift them shares. And there's some gifting limitations. We'll talk about that a little bit later. It's easy to do. You can do it right at Wells Fargo. You can do it at LPL. Set up an account for them. Have shares journaled over to their name. Okay. Any other questions?
Back one slide.
Sure. This one?
Yeah. I guess I don't understand. Subtract 3% of excess from itemized deductions,
Basically, they take back some of your itemized deductions,
just 3%?
up to 3%, but again, it keeps ratcheting up. They can take up to 80% of your itemized deductions.
Oh, and how do you figure out how much they're gonna take?
It's just a sliding scale.
Oh,
It just keeps sliding and sliding. Basically, what they're saying is, the highest tax bracket we live in Minnesota, you should really be in a 52% tax bracket. If you're at the top, lots of investment, it can be 52 or higher.
Okay. All right. So the dividend tax is pretty much right in line with the capital gain tax rates. It could be 0%, could be 15%, could be a 20% tax rate on your dividends. Now, so the other area that stock sales could impact your tax return is taxability of your Social Security benefits. So how this works is if you're drawing Social Security and you're in a really low bracket and all of a sudden you have a capital gain, well, that could create taxation of your Social Security benefits. Because right now, if you're under, let's say, $36,000, married filing jointly, you don't have to pay tax on your Social Security. But then once you go over that, then all of a sudden they start taxing the income you're getting from Social Security. So I might be looking at it and going, oh, well, Sean said it's a 0% tax rate on my capital gain, but then you do your tax return and just go, well, how come I have to pay tax? Well, what they're doing is they're taxing your Social Security. So again, all this kind of ties together, and you pretty much need to have some you know, sort of software or a CPA or somebody that's running these tax calcs for you to find out what's being phased out, where you're losing deductions, what you know, what tax bracket you're in, what's the capital gains tax rate, and so forth. Now, the
Question, Sean.
yes,
It's in regard to Social Security, you're getting a pension, say.
uh-huh.
They're not gonna take all of, it's treated differently than like, what we're getting on, say, capital gains is treated differently than ordinary income. So they're not gonna take all your Social Security, you know?
No.
What I'm saying?
Yeah, Social Security, it's a tricky formula, and we have a class on Social Security, but how it works is basically it's called your provisional income, which is a calculation. Take your income that you have coming in, they take half your Social Security benefits, add it together, and then that's the beginning formula to see if your Social Security benefits are taxable. And so they don't tax all your Social Security benefits, only a portion of them. And up to 85% of your Social Security benefits can be taxed as ordinary income. Yeah.
Nice to know.
Yeah, it's kind of a drag because you get your Social Security statement and they might say, okay, you're going to get $2,000 a month when you retire. And then you start getting your checks and you go, oh, by the way, they're going to deduct out, the Medicare plan, Part B, and then pretty soon you go to get your taxes done and surprise, surprise, you have to pay tax on the Social Security that you've just received and you didn't realize that. So they tax everywhere. Yeah, you're welcome. Okay. So at this point, what I'd like to do, Dan Freemuth, he's a certified public accountant, and he's going to talk to you about, just go through some different tax hypotheticals of different clientele that we've worked with in the last few months here. And how about a warm welcome for Dan Freemuth?
All right. This is the big packet in your folders. If you want to look at it, or I can just try to explain what's going on. But basically what I did is I pulled out 3 different scenarios out of my client base and said, how would something like this Medtronic conversion affect them? I mean, and the first one is specifically on that Social Security that Sean was just talking about. Person's got dividend income, Social Security. So basically they're retired, but they're not drawing out of their IRA or their pension yet. The reason why they file a tax return right now, property tax refund in Minnesota. Don't care after that. But then if they sell half of their stock, all of a sudden, 85% of their Social Security gets bit. So you get hit twice instead of, so you get the Social Security you're paying tax on and the dividends and the capital gains. All of a sudden they just start stacking up. And specifically in these examples, I made 3 assumptions. 1, you ignore the problem. You don't do anything this year. Number 2, you decide, let's be proactive, let's try to go half and half. Sell half this year, hope Medtronic can't get their act together until 2015, give you an opportunity to do something. The third option is the other extreme. They do it all this year. And that's what all 3 of them do. The other assumption is we're taking advantage of prepaying our Minnesota estimated taxes early to get the itemized deduction if it's going to help you. So that's give you just a quick synopsis on that, and let me see if I can find it. I really don't like what's up on the screen because I don't think you can read that very well, can you? So we'll just go off of your notes, and I'll ignore that for right now. So in this first sample that we have, do nothing, 50-50, sell 100%. If you do the 50-50, it can save you about $18,000 in taxes because you get to take advantage of that 0 tax bracket that when you're in the 10 or 15% tax bracket. So that's where this proactive thinking ahead says, okay, maybe I want to do this because it gives you an opportunity. If you just put your head in the sand, you lose $18,000. I don't like anyone paying more taxes than they have to. This is a bad bet. That's where, but every one of these is different. You have to look at where are you, because each one of these scenarios takes some different assumptions. So the first one, I would say if you're in that retired, you haven't started taking your pension yet, nothing out of your IRA, you might want to start thinking, let's go with that 50-50 to protect yourself. Gives you $18,000 of free money, basically. I like free money from the government. So in the second scenario, you're either still working for Medtronic or you're retired and you're already drawing your pension and those things, and you're making about $105,000 just because that's what you make every year. This one, you don't have a mortgage, you've paid off everything, and you've got about $500,000 of gains sitting in your capital gains. If you go bury your head in the sand, you lose $17,000. With the 50-50, you save it. But in this example, and this is what Sean really didn't touch on, and it's hard to, we have this lovely alternative minimum tax. If your income gets to a certain level, your itemized deductions are too high, the government says, we want about 26% of your federal income in tax. So in sample 2, there's a $10,000 AMT hit if you sell half. If you look at the selling it all, that AMT amount jumps up to $22,000. So that's something that by going with the 50-50, we can either keep you out of the AMT, or sometimes selling it all can push you right past the AMT, and you can avoid that. You can take full advantage of everything. Yes?
If this inversion goes off this calendar year,
You're stuck.
No matter what
I
you
guess
do.
I'm not missing it.
No, you're not. And that's because we don't know. It's my personal gut feeling is I don't think they can get their ducks in order before year end. But with Congress and President Obama saying we want to prevent you from doing these, they might hurry up and do something, and then you might be stuck. But this is, I think, that when they have the shareholder meeting and people are upset, they're looking at this going, wait a minute, we don't have any choices. You're telling me I am stuck paying this $18,000 penalty because you guys are doing something on top of all of this.
So you're proposing if it doesn't go through, at least go 50-50 this calendar year?
It depends. And that's where the third sample, if you look at that one, and I'll just go on the summary page, you save $1,000. So it depends on who you are. Each person is different. I can say, which one of these do you fit into? You might fit this one, you might fit that one. Some people, doesn't matter. If you're gonna save $1,000, you probably don't care. If you're gonna save $17,000, you care a lot. Because now Medtronic is saying, hey, we're doing something to save themselves millions, billions of dollars in tax. You're stuck writing a big check, a bigger check than you wanted to. So that's basically what this is doing. And with Sean's clients, the ones that I have done, I do this for all of them. I give them scenarios and say, this is what could happen, this is what couldn't happen, but it gives you a fully informed decision. And I'm telling people, even if I'm not the one to do it, talk to your tax preparers. Let them run some of these numbers. Because if you're writing a check for $17,000, $18,000, $20,000, $100,000 because you weren't prepared, you're upset. And you probably should be upset maybe with your preparer, maybe with yourself, maybe Medtronic. But if you're informed, you're not surprised, and it's easier to say, how can we prepare for this to save ourselves some money? So that's what this is, and I can't get into specifics for each person. That's why I'm going to stay after for about 45 minutes so people can ask me how it fits better to them. Yes?
So your examples are 0, half,
And all.
But you could tailor that, obviously, to try to avoid that AMT tax.
Right. It's,
Of 40%.
yeah, you could say I want to get right up to the AMT. I want to go to this year I want to go to the top of the 15% tax bracket, so I'm not paying the 20%, or I don't want to get above the 39.6%, so I don't go up to the 20%. So yes, there's a lot of customization, but I can't do it. For a group like this, it's hard to say I'm going to customize it to everyone. But going with those 3 examples, it kind of gives you a feel for where the sliding scale is for what you can and can't do. So, yes?
Sorry to ask this. but
Go
can
ahead.
you explain the AMT again?
The alternative minimum tax kicks in when you have too many deductions and your income, what Congress wants is your average income tax to be 26% on your federal return. You have too many deductions, you start sliding below it, the AMT kicks in, bumps you up to this, and every year there's always been this patch. Every year, usually Congress in November goes back and says, okay, we're not going to kick the law back to the 1992 law where AMT kicks in at about 100,000. They've now made it permanent, so we don't have, but if you read the paper, usually this time of year it comes up. Now it's permanent, so these examples are, I would say, pretty well set for what the AMT is going to look like for a while. The one other thing that, in these examples, I'm assuming Minnesota, everyone lives in Minnesota. We have this new extra 2% tax for 2013, 2014. How many people think in 2015 it's going to go away? I'm seeing laughing. I agree. So I'm assuming that that 2% tax is going to be there for a long time.
So at what AGI does the AMT kick in?
Usually at about I want to say about 300,000, because again, it depends on what type of taxes you have. But like this, I want to say in sample 2, I want to say we're at 387,000. You're at $10,000 in AMT. Do the math, back it off by 26% to get down to about 300,000, and you're out of it. But there's a big range there where you're trapped in that AMT and you can't get out. And no other questions on that part? And again, I'll stay afterwards to talk to you about your specific situations and what we can manipulate for you, and especially with the gifting and the kiddie tax that Nate's going to talk about.
Great. Thank you, Dan. Is it crystal clear for everyone?
It's clear as mud. you're gonna be taxed a lot. Well, that's a good question. President Obama has said Congress doesn't act. I don't think he has the authority. There have been 2 cases at the Supreme Court, not recently, on inversion. Both times inversion won. However, it takes cases a couple of years to get to the Supreme Court. So he could do something, and everyone's tax returns are in limbo for a couple of years. You file it under what the law is, and then you might have to file for an amendment to get your money back. So it could be really ugly for a long time.
Yeah. That's the reason why we have Dan here, because everything that we do revolves around taxes in one way, shape, or form, and what better man to know taxes than one that has done a lot of these Medtronic type returns for us and working with the specifics of your stock purchase plan shares. So that's the reason why we have Dan here. He said he'll stay here afterwards so that you can ask him more questions. Now remember, this came up just a little bit ago, but I'm going to start talking about options you have available to you. Those options are very, very few if the deal happens this year. So while we can do a lot of preparation and planning, we don't know the final logistics as to when some of these issues with Medtronic will get solved, and especially with the federal government. So with that being said, I'm going to kind of go into a lot of different options. Also with that, these options are available in the sheet that we gave you. Sean and myself, we put out this kind of white paper on your options. This was probably a good couple of months ago now that we did this. Give these to your coworkers, your friends, anyone who wants to know more. If you need us to email it to you, we can definitely do that as well. But these are a good reference, and this is actually going to follow with what I talk about here a little bit. So with that, we do have, I'll get to the slides here. All right, well, one too many, but it was just talking about the options. The first option that we have available is what Dan was actually discussing a lot of, that we can actually defer some of your sales proceeds to next year if the acquisition happens next year. So that may be very beneficial to split up your amounts of sales proceeds over the course of 2 years. And that's one thing that we can do. The other option that you have to you, or should say another option you have to you, is what we have up here. It's kind of working in tandem with your 401k. For those of you who are working currently, you are still contributing to your 401k. What that means is that you're actually taking money from your paycheck, pre-tax, and putting it into your 401k for savings for the future. Well, we can do a change. If we have to sell some shares this year of your Medtronic stock, we can offset that. We can say, well, let's sell some shares here, let's realize the gain, but let's increase your qualified plan, so your 401k, the contributions to there, and now we're taking less home from your paycheck, so you're receiving less from Medtronic as an income, but now we can use some of the money that you have from your stock sales to live on. That can be your proceeds. Question?
3 months left.
The comment was that you have 3 months left. The answer is yes, that is correct. There are ways that we can help. You can go up to 75% per paycheck into your 401k. We've known about this since about June. So we have been working, this is some of the planning process that Sean and myself go through to work with that to try to increase contributions as necessary. For those of you who have yet to do it, and this may be a good benefit for you, it's never too late to start at least to contribute now, solely on the fact that you can still get more tax savings from that just by deferring your 401k. So that's a little bit about what we talk here.
Timers set a quarterly deal they have to sign up for, and they have
The question is, can this happen anytime? The answer is yes. You can call Vanguard up, or you can go on to Vanguard's website, and right there will just be how much of a contribution you want to put from your paycheck, and you can go up to 75% of your paycheck, and it will be for the next pay period. So I did this just a week ago or so with a client, and both her and her husband had 2 separate 401k plans. So we increased their contributions to their 401k. In tandem, we did some selling. Now, if you're thinking through this, her income was actually now roughly about $300 or $200 a paycheck. Not enough to live on. So that's where we took the proceeds from her stock sales, and we were able to use that as living expenses now for the rest of this year. In effect, trying to reduce taxes, and I think we're doing a good job with that, and that's something that you can also work with as well. That's not the only way that we can work with things. For the retirees as well, we can also work with this too. There are 2 different types of IRA accounts. A Roth IRA account is one that you take money from your checking account and you can put into a Roth IRA, and this says, I have tax-free growth. So if you're working, say, part-time and have a little bit of income, you can still put away to a Roth IRA. Well, the same is true with a traditional IRA. If you fall within some tax brackets and you're, say, retired, so you don't have your 401k left at work, now we can possibly put into a traditional IRA. That's still money that comes from your checking account. So nothing's changed there. But the thing we can do now is possibility that it can actually be a tax deduction for you. So we can put into a traditional IRA, have it as a tax deduction, and that can be used to lower some of the taxes on the sales proceeds. Yes, Pat?
That's only if you're working, correct? 'Cause that's what I've been.
That's only if you're working. That is true. And for those of you who are at Medtronic, you don't qualify for this aspect of it solely on the fact that you do have planned through Vanguard in your 401k, and so there's some qualifying, I guess, qualifying demeanors for if this is something you can do or not. That's why we're here to help to kind of answer some questions. But this is one option for those of you who may be semi-retired and want to do something like this. Yes, Bruce?
What if you get a whole bunch of money because you had to sell this year? Are you allowed to put your money in your traditional IRA then?
Are you allowed to put it in without any earned contributions or earned income?
You have to have earned income before you can contribute to either one of these.
Right, and now what if you have a,
Yeah,
And there are income limitations.
correct.
If your income is too high, you're disqualified from either.
Yes.
wasn't stock sales counted that kind of income that disqualify you?
Yes.
If it did disqualify you, what can you do?
Take the money out.
You can take it back out of the
Yep.
IRA without being in trouble?
The only thing you'll pay, you'll get a 1099-R, and you'll pay tax on the growth.
Okay.
Because if it grew, you're gonna pay tax on that growth. If it lost money, tough. It's Schedule A itemized deduction, subject to 2%. It's not gonna go anywhere.
So this is one to hold for next year.
Yes.
Yeah, this is definitely something that we can work with, but you're still up to the maximum amount you can put into an IRA, which is $6,500 for those of you over 50. So we still have some limitations here as well, and so this is definitely something that to think about though as well. Another question? Yes.
If I heard you correctly, you're saying that if, let's say my income is $100,000 and I sold some of my shares, but I wanted to put it into an IRA. Before I put it into the IRA, whatever I've sold, that's then now my additional income that I'm gonna get. Is that what you said, or did I miss?
It's additional income that you're taxed on, but it's not. There's a difference between passive and active income. Dividends, capital gains, those are passive, they're not earned income. They don't qualify, it's not income that would qualify you to put money into a retirement account. You have to have W-2, Schedule C, before you're eligible to do this. And the other thing with these are things you can look back and fix. You can say before April 15th, the inversion doesn't go through, you can put money in for the prior year you have till April 15th to say, I'm gonna put money in or I'm not.
Yeah.
So you're not stuck getting back to, I put the money in, do I have to take it out? You can hold off and wait to say, am I gonna put the money in or am I not?
So isn't that kind of what we wanna do though? I mean.
This is definitely one option.
Put it into something else, whether it be a traditional IRA or something else, so that we're not.
This is definitely an option and this is one to consider, but remember, the limitation here is that if you have, basically if you have access to a 401k and choose not to participate, or you are participating, you still cannot do a tax-deductible IRA. So there are still limitations here, and it's because they want you to put more money into your 401k, and that's actually a better deal for you than doing a tax deduction. So this is basically lowering your taxes right away versus trying to take a tax deduction on the amount.
Your example of 75% of my paycheck go into my 401k and then sell stock to live on that as.
That's definitely one option. Like I said, these are all options that you have available, and this is why we have a lot of different.
But to your question
yeah.
specifically, your earned income, which is ordinary income, that's what you're deferring. You're taking capital gain income, which is taxed at a lower federal rate. So you may have the same number of dollars, but you might pay substantially less tax doing taxing with the 401k and selling your stuff.
Yeah. Yeah.
Is there an earned income level on the Roth?
There is. I believe for married filing joining somewhere, the phase out starts, what, about 175, something like that. The same thing with tax deductible IRA contributions if you do not have a plan at work. So we're going to move on. If you have any more questions, you can see myself, Sean, or Dan at the end here. We had questions about kiddie tax, and more importantly, gifting some of these shares to family members, like children. We had, this was last week, we just finished up a gifting situation where we were able to help one of our clients gift. We did 50 shares to each of their 7 kids. So that's something that now you can take gifted to them, and that's out of your tax bracket, that's out of your taxes. And so now you can actually remove that from your taxes. They can sell it, it goes onto their taxes, and that's absolutely what we want if we're trying to minimize your taxes, because they may be in a lower bracket. Question though.
What if you're paying their taxes too, right?
If you're paying your taxes, we you know, there's something here we need to talk. Question. Is there a time when you can gift to your children and then you end up having to pay their taxes or part of the stock sale? Yes. And that's what we're talking about here with respect to the kiddie taxes. If you're gifting to minors, and the definition keeps changing now of what a minor actually is, and so they're saying if you have children at home that are under the age of 19 who are not going to school, or you have children that are 24 and younger who are in school, they are now subject to this kiddie tax. And what that means for them and for you is that some of the sales proceeds will be taxed to them, and some will come back onto your taxes. And so that's where we have down here on the unearned income. This is what we're talking about with your selling of the Medtronic stock. The long-term capital gains, the dividends, those are all considered unearned income. And the first $1,000 for a minor, and this is on their tax bracket, is tax exempt. They do not pay any taxes on that. The next $1,000 for them, they pay 10% taxes on. So that's of that 1,000 they pay 10% on. Anything over that $2,000 of unearned income amount, this goes back to your highest tax rate. planning this correctly, it can be a great thing. Incorrectly, and all of a sudden, you can have it come back to you where you never thought it was going to. Now, this is only for minors. For some of your sons and daughters and children who are of age, this does not apply. If you gift shares to them, it goes to them, it stays with them, it's always in their tax bracket. If they're in a low tax bracket, great. If they're in a high tax bracket, it happens. Question, yes?
Crazy question, so, we have older children, if we gifted some of those shares to them, are they then burdened with that inversion?
That they will be. Anyone who is a shareholder at the time of the inversion will be subject to, in some way, shape, or form, of selling. So by you gifting, you're basically making them a shareholder.
For whether, if they hang on to those shares for 50 years?
That is correct. And what Medtronic is saying, that no matter what, if the inversion goes through, no matter if you want to sell or not, they're going to hand you a tax bill. Yes. Yes.
Same basis though, right?
That is correct. Yep. So.
As you die, give it to them as you die.
No, you give it to them after you die, not as you die. Timing is important.
Yes.
Well, that's,
Leave it in an envelope on the dresser.
Yeah, so the basis stays the same and it will go to them. So some of your shares are probably 30 years old or more, and you probably have a cost base, maybe $2, $3 or so after all the stock splits over the course of the years. So now you can gift them, and that's actually one of the things, and I apologize, this is a new system and it keeps timing out, so the screensaver keeps coming on, so sorry I have to keep working with this. But
Okay, you had a question back there.
What's the max you can give a child a year?
$14,000. However, I tell everyone, don't write a check for $14,000 and give it to them. Because then if you give them a birthday present, a Christmas present, take them out to lunch, you're over the gift for the year, and you're supposed to file a gift tax return.
Is there a max in what you can donate stock-wise? Or could you donate it all if you want?
You can donate it all. The amount that you can deduct per year, if you donate stock, you only deduct 30% of your adjusted gross income. The rest carries over. So if this year your income is $1 million, the first $300,000 you get tax deduction for. Anything over that carries forward in the future years.
yeah.
But you can, give to other relatives besides.
Yes, and spouses are not considered the same person. So you're married, if you have one child, you can give $13,500, you can give $13,500. If they're married, you can give $13,500 to their spouse and $13,500. So you can start moving a lot quickly if you want.
Absolutely.
It doesn't have to be children of your own children, it can be any kid on the block.
It can be
Any person, absolutely.
It can be your hairdresser.
Yeah.
I don't have any hair.
Yeah.
Does
Yes,
it
Colleen.
matter if the stock is in one spouse's name or both spouses? There's no difference.
As long as you make sure that you clearly identify how the gift is being made.
Yep. Absolutely.
No, but I mean, just in general, there's no circumstance where it matters.
If it's an irrevocable trust, yes.
There is also for estate taxes as well. If you are into the higher echelons of, say, net worth, that could come to matter at that point in time of whose name is actually in, because then it would depend if, say, one person has $7 million to their name and one person has $300,000. Well, one person is going to be saddled with a lot of estate tax, and the other person is not going to have any. And so this all comes down to the best ways to work with it. That's why Dan's here. That's why we are here to help with some of those questions. Let's keep moving so that we can talk through all of this. If you have more questions, we're here at the end. When we're talking about gifting, though, to other people, whether it's children or others, is in your best interest to gift stock that you've had for many years. So some of the older shares that you own that are highly appreciated, because those are the ones that have the lowest cost base, and they can do the most good for removing it from your taxes. Now, the ones that you've maybe purchased 3 years ago that have, say, a cost base of $45, those are fine because those don't have as much of appreciation. You're not going to be selling as much when time comes, but that's why we want to take some of the lower basis there. Other things we can do. Donate to charity. If you're going to do it anyway, do your stock. Absolutely. One of the best things that we can do here is donate stock to charity. Donate to charity. This is going to get a tax deduction. Now, there's two ways of doing this. You can say, on the one hand, I want to sell all the shares today and then donate the cash. On the other hand, I just want to donate the shares and I'm not selling anything today. They each have tax consequences to you. I'm going to break down this entire chart for you of what we had. Basically, this is saying the scenarios that I went over, that Winnie decided she wanted to sell her shares first and then donate to the charity, whereas Chris decided, I just want to donate the shares to the charity. I don't want to sell them first. Breaks down everything all said and done. Chris comes out ahead because he donated more to the charity, took more of a tax deduction, and had more savings in the course of the federal tax value that he received by donating the shares versus selling first. So if you are thinking about doing this, you can actually do this where Medtronic can actually do a matching gift as well. So I'd say definitely look into that, take advantage of that. And this is something that many charities actually have a gifting program set up that you ask for their information on how to give shares, they'll give it all to you. You can do that very easily.
How do they determine the
Yep.
fair market value?
How do they determine?
Say I give somebody 10 shares.
Yep.
What's the fair market value of those 10 shares?
So the question is the fair market value of those 10 shares. If you're gifting to a person, it's going to be the cost base that's going to transfer over, and the fair market value, if I remember correctly, is the date of transfer.
The high-low average.
Yep.
Day of transfer.
Oh, okay.
So if you're looking throughout the day, the stock price goes up and down. They're going to take an average of the two between the low and the high of the day, and that's where they'll look at the date of the transfer. The same for charitable as well. So we have this, but for some of you, you say, you know what? I can give all this stock away, but I wanted to live on. This was stock that I wanted to live on, that I need to live on. How can I do this, reduce my taxes, but on the same line still have money available to live on? A trust is a great way to do that. So what this says here is that if we do it correctly, we can actually donate all of this stock. In this example, we have $1 million of stock that we donated to the charity. However, now you can say, I want a stream of income coming from that charity and from that trust so that I can live on that income. And we can even go one step farther and say, well, in addition, we'll purchase a life insurance policy with some of that stream of money so we can have something set up for the kids so the kids can come out ahead as well. So there's a lot of different options here. So we can remove the taxes associated with the sale from your personal taxes. We can have the tax deduction from the charity by gifting these shares to the charity, and we can have a stream of income coming in so you can live on, and that will go for the remaining of your life. So these are some great options. There's a lot here though, so every situation is unique. We'll talk more specifically about that later. Lastly, we'd also change residencies. This will not save you from federal taxes, but like Sean had mentioned a little bit earlier, the state of Minnesota can have up to 10% in state taxes, right? Just shy of 10% for state taxes. Will help you save some of the state taxes and thus trying to save obviously, and money that you spend on taxes. Now, the nice thing here is that if you're going to do this, the law stands that it's 6 months in one day. Earlier today when we had the workshop, I was always saying 6 days in 1 month. And I said that like 3 times, not catching myself. It's 6 months in 1 day is the criteria for establishing residency. And there's a whole list of others that we have here as well. So if you need to know the criteria, I have all the criteria for establishing residency. But there's actually, if you're going to sell your house, move before year's end to a different state, you can do that without that 6 month and 1 day provision that they have. So you can actually claim residency in another state a little quicker. That's something that we can help work through if you're deciding that you want to do that. I did have a client that right away when the news came out that they decided they wanted to do this, they had sold their house within 3 weeks of the Medtronic news coming out, and they moved to Florida. Almost immediately, they bought a condo down there. And so they were proactive in doing this. That's the most proactive I've ever seen. But this is the reason why, because now they can save on some of the state taxes associated. So where do we go from here? There's a lot of ways that you can work with this to think about your stocks. One of them is that you can do it yourself, that you can look through all the options that we've given you and say, this is as clear as can be. Let's do it. Let's do all the little details. Let's plan this all out. Another way that you can work and go from here is the fact that you say, I want to work with someone else. That's perfectly fine. I would definitely suggest so that they have a knowledge of Medtronic, a knowledge of the tax brackets of how we can sell Medtronic shares and the best ways of doing that so that they know what's going on with that. Third way is that you work with our team here at Summit Investment Advisors. We know all of the different aspects of the Medtronic acquisition. We know all the different aspects of not only your stock purchase plan shares, but we will be having a stock options workshop here coming up in 2 weeks. We know all of the stock options that you have available to you. And so we can definitely talk about that. And we can even have people like Dan who knows all the different little Medtronic nuances and how to work with that on your taxes, step in and help us as well. So we are here to help. We are here to provide any assistance we can. And with that, I'm actually going to turn it over 1 last minute to Sean as we wrap up.